We're going to begin soon. You're just on mute. Perfect. Good afternoon, everyone, and welcome to the domestic portfolio section of the Growthpoint Investor Day. The final part of the traditional commercial portfolio is going to be presented by Errol Taylor, the head of industrial, for an update, what's happening in the sector, as well as some, market information, which will be followed by Q&A thereafter. Just some housekeeping issues from our side. Please remain on mute and ensure your video is off. Thank you very much, and over to you, Errol.
Thanks, Nazim. Good afternoon, everyone. Thanks for joining us. The graveyard shift. I'll try and keep it short. So just with regards to where we are FY 21, we've reduced the number of properties due to some disposals that we've had. And the industrial portfolio makes up about 18% of the Growthpoint SA portfolio. And about 61% of that's located in Gauteng, with 21% in the Western Cape and 18% in KZN. So we're fairly well distributed between Joburg, Durban and Cape Town, or the broader Johannesburg region per se. We also are fortunate that we provide space to about 960 odd tenants, and our GLA in industrial makes up about 41% of the total GLA of the three sectors combined, at 2.2 million square meters. Our value 12.3 billion rands, which clocks in at about 5,164 rands per square meter, which is relatively low compared to some of our competitors in terms of the new stock and that's on the market. And our vacancy factor 9.4% at the year end, with arrears at about 59 million rands. So just looking at an overview in terms of the impact of COVID on FY 21, we were severely impacted from March last year, and we've certainly seen that towards the latter part of the financial year, that trading conditions have started to pick up again. Without a doubt, there's still restrictions on certain types of businesses, especially those in the events industry, where due to limitations with regards to the COVID restrictions, these types of industries weren't able to trade effectively. But we do see that at level one, consumers will again start to re-emerge, and most businesses will start getting back into the swing of things again. There have been substantially less requests for rental relief during the last quarter of FY 21. I think, when we started off in the financial year, July, August, September 20, the overflow from the impact of COVID and the hard lockdown that we had was quite significant, but that has definitely tapered down by now.
Errol, you are on mute.
Yep.
Apologies for that. I don't know how that happened. Can you guys hear me now?
Perfect.
We can.
Right. Sorry about that. So as I was saying, from FY 21 in the last quarter, we've had minimal requests for rental relief as businesses have started to pick up again. However, we do find that clients are still wary with regards to any sort of long-term commitment, as prudent businesses don't want to commit themselves to obligations in terms of a contract which they are unable to execute on. And we also find that arrears are tapering down quite significantly. They are still, however, at levels which are substantially high compared to our historical arrears levels, but they are substantially less than where we were a year ago. And there are still one or two sort of major tenants, large tenants that have got difficulty in terms of being able to keep up to their rental obligations, least of which have been affected by aspects such as load shedding and, of course, the unrest, as well as the recent strikes that we've had. Without doubt, the rollout of the vaccination program is improving the ability for people to open their business and to trade, but we do believe that it's happening at a much slower pace, and this is going to impact, unfortunately, on achieving our herd immunity targets, which I believe are going to be delayed relative to the anticipated dates that we were supposed to achieve these targets by. Our discounts have increased by about 45% year on year within the FY21 year. And as I said, that's mainly as a result of the rollover from the first sort of impact of COVID, which happened April, May last year, which only really kicked in within the new financial year, which was from July F20. The deferrals had decreased by 81% year on year, with an effective net recovery rate of 88.6% on about 70.6 million rands. Moving on in terms of market conditions, we do find that there are still a number of tenants who are capitalizing on the weak property fundamentals that are trying to, make use of the opportunity to try and commit the landlord to lower rental tariffs and lower escalations. So as a result, rental growth remains under pressure. Reversions continue to dominate, and in-force escalations are inflated beyond market levels at this point in time. Assessment rates increases remain an issue for us, more especially in some of the coastal regions where the tariffs are just way out of kilter. The costs associated with electricity charges, electrical tariffs by local authorities as well as Eskom continue to exacerbate the cash flow challenges, and the cost of occupation obviously increases at a time when the business sector is so fragile and can least afford these massive increases. Load shedding, I'm afraid, remains a real issue for us, not just in terms of manufacturers who are unable to conduct their business on a regular basis, but it also impacts on those who are in the logistics and distribution business, trying to get goods moving along, distribution channels within sort of built-up urban areas where traffic lights are impacted, are causing major delays for a lot of these deliveries to take place. However, logistics and distribution segment continues to perform well. Without a doubt, there is a surge in transportation relating to FMCG goods, as well as mining and agricultural products. Shoppers are starting to return to the retail outlets, as indicated by Neil previously. However, online purchasing still seems to be popular and provide shoppers with a convenient shopping alternative, and shoppers are becoming more comfortable with such a convenient alternative as a shopping format. There is still a strong appetite for industrial acquisitions. We find that there are non-institutional investors out there searching for discounted valued assets, and more especially in the public auction realm. But again, having said that, I do believe that there are green shoots within our economy, and these growth shoots are certainly going to assist businesses in recovering. However, there is also talk about a fourth wave, which might be happening towards the end of this year, and I keep on wondering as to and marveling as to how resilient our businesses are in terms of recovering and still being able to continue going forward. Tenant arrears are starting to stabilize as businesses pick up and sales improve. The number of business rescue cases and or liquidations have diminished without a doubt. There are still, however, some die-hard defaulting tenants, and unfortunately, we need to continue, the legal process with those tenants with whom we can't achieve some sort of settlement plan or payment plan going forward. The likes of tourism, restaurants, events, and leisure type industries are still exposed to the restraints of the COVID-19 pandemic, unfortunately. I do hope that with the recent relief that has been granted to get us back to level 1 will afford these businesses an opportunity to start getting their business back onto their feet again. We do expect that international travel will start to increase again in the third quarter and the fourth quarter for 2021, and without a doubt, this will certainly facilitate those tenants who are in the tourism and restaurants and leisure type industries. Work from home still remains a reality, however, and a number of businesses are returning to the office, albeit on a shortened work week, with some staff still working from home 2 or 3 times per week. That's evident, as Paul also mentioned, in getting to the office this morning. Congestion is a reality. From a valuations point of view, we found that we had a reduction of 5.9% to 12.3 billion, a reduction of 78 million on the portfolio for the year. And this is mainly due to an increase in the weighted average cap rate, which moved from 9% to about 9.4%. Also, the exit cap rate moved from 9.5% to close on to 9.9%. And we've had a decrease in market rental growth rates from about 4.5% to 3.8%. Furthermore, market-related rentals also have decreased, and there's also an increase in the sector's vacancy of about 2.4%. So, in a nutshell, industrial valuations decreased mainly due to conservative changes to reversionary cap rates, as well as market rental growth rates. I do expect that we won't be hit with a similar sort of devaluation at our next cycle of valuations, because it's quite evident that our vacancies have started to taper down, which is a great thing for all landlords at this point in time. From an acquisitions point of view, there were no acquisitions for us in the reporting period. But from a disposals point of view, we did try and capitalize on the buoyant industrial market conditions, which has certainly facilitated the disposal of a number of non-core assets, especially to those non-institutional investors who are seeking an opportunity to create their own investment portfolios. We continue to list non-core industrial assets as potential disposals, in keeping with our strategy to rebalance the industrial fund by both type, size, and location. And interest remains strong. 6 non-core assets of some 300 odd million are being transferred during the financial period, while simultaneously attending to a number of transactions in various stages of the disposal process. I might just add that in the FY22 period thus far, an additional 6 disposals have also transferred, and there are probably another 16 properties in various stages of transfer process, which will materialize during the course of the year. From a development and redevelopment point of view, we're very pleased to say that we've been able to do a development for one of our existing clients, Beckman Coulter. We're developing 5,700 square meter facility at our Central Point precinct in Samrand. They're due for handover as we speak, and we're quite happy that we've managed to let a number of our new developments that we did in previous financial years, the likes of Midrand, Sterling Industrial Park, where we developed 27,500 square meters, 8 freestanding units. That's fully let. In Mount Edgecombe in Durban, at Trade Park, phase 1. That's also fully let at 20,300 square meters, as well as Belleville in Cape Town, where we did a Mole Road Industrial Park phase 2 at 13,200 or 4 units. That also is fully let. So at this point in time, certainly within the coastal regions, we find that there is a strong growth in terms of occupancies, and long may that continue, and may it also spread to the Gauteng inland region, and we look forward to that happening. So that's about it in terms of the presentation that I have. I don't know if there are perhaps any questions that I could attend to.
Definitely. Thank you so much, Errol. Just a reminder to the participants, if you'd like to ask a question, you can use the chat box function, raise your hand or email me. We've also received one or two via WhatsApp. Maybe a question I received while you were chatting about the portfolio on average rentals. But before we get there, maybe on the 12 billion portfolio, could you maybe provide just a broad segmentation of the various industrial that you operate in?
Certainly. So about 40% of the fund is made up of call it distribution, logistics and warehousing components. And then there is what we call a multi-tenanted facility. The warehouse distribution and logistics components are generally single-tenanted type facilities. Then we have our multi-parks. And these are facilities which are occupied by multiple tenants, not necessarily the typical mini type unit buildings that I'm referring to. That makes up also probably around about another 40% of the fund. These numbers are all in our financials as reported. And then, of course, there's a manufacturing component, which from a space point of view takes up a substantial amount of space. But by value is far lesser in terms of the 12.5 billion rands worth of fund.
Brilliant. And then maybe just to line up with the average values of 5,000 rand, do you have an average rental for the portfolio?
Yeah, so average rentals probably kicking at about 50 bucks a square meter, and it's very difficult to say average because the fund is made up of so many different components, unfortunately or fortunately. So it's very difficult to generalize in terms of that. But certainly in terms of A grade type stock, the rental levels are substantially higher. We also find that in the KZN region, as an example, the market rentals in that region are also substantially higher. So that kind of skews the averages if one looks at it on a national basis, unfortunately.
Given that tenants are not willing to commit to longer leases, has this been countered by a reduction in churn? Has it improved loyalty potentially, as they take on these shorter leases and you're willing to accommodate?
So, with a lot of the tenants, we have a very strong loyalty base. Many of the tenants have been tenants of ours for a number of years. And we do bank on that loyalty component without a doubt. We have found also that we've built a lot of credibility with the tenants, given the fact that we assisted so many of our clients in terms of rental relief during the COVID period. So I think there's a quid pro quo associated with it. And without a doubt, some of the tenants are in fact committing to long leases, but in general, most of them are trying to keep it as short as possible.
And we've got a question here from Murray. Growthpoint has spoken about telco assets before and the potential to set up a funds management business with these assets. In the meantime, I assume they sit in the industrial portfolio. Could you give us some information on these assets? What type of telecoms, average lease length, average rent, average value per square meter?
Yeah, so in fact, the telco fund is managed separately, but it isn't reported separately. It is lumped within the industrial numbers. So I'm afraid I'm not too au fait in terms of the detail associated with those because it doesn't actually fall under our umbrella as such. I guess what we can do is Werner van Antwerpen heads up that particular fund, and I'm quite happy to ask him to give us an overview of that information to share it with you.
Brilliant. And with regards to the disposal strategy, you talk about the selling of non-core assets, what proportion of your portfolio do you consider non-core?
So it's a good question. When we talk about core, we obviously talk about those facilities that can attract blue chip tenants on long-term leases where we can get a sustainable cash flow associated with their occupation and located in prime nodes. So those which we deem to be non-core would be the opposite of that. And obviously there are a number of those which we believe might avail themselves for redevelopment opportunities. But then there are those which we believe are possibly located in areas where market rentals won't deem it feasible for us to do any sort of additional capital expenditure. And those are the ones that we would then put out as non-core assets, and the ones that we find that don't necessarily meet our investment criteria would be the ones that we want to dispose of in the short to medium term.
And then if I may elaborate, which nodes do you consider to be sort of, I wouldn't say uninvestable, but, ones that you want to sort of exit and the rationale for that as well, please? So
it's a combination of both node as well as concentration. In some of the nodes we are heavily concentrated, and we, from a risk point of view, would like to maybe just mitigate our concentration in some of the nodes. An example of that would be Epping in Cape Town. We've got probably about 22 or 23 assets within the Epping node itself. Nothing wrong with Epping. Epping is a great node, but from a concentration point of view, it affords us the opportunity to maybe dispose of some of the smaller type assets and allow us to then reinvest in assets which provide us the opportunity to secure blue chip tenants. Here in Gauteng, I guess we would like to avoid the West Rand and maybe concentrate our efforts more on the East and our North portfolios. So it would be that sort of corridor between the airport and sort of Samrand. That sort of area is definitely a great growth area for us.
Thank you. Question from Yusuf. What kinds of assets are you looking to accumulate? Are single standalone assets being reconsidered from a safety cost point of view?
Yeah, it's a very good question, Yusuf. Without a doubt, there is a desire for security, and security is deemed to be accomplished by means of being within parks where you have an external perimeter. And then within the park, you then find that, you still possibly have a security fence or, an access control point to your particular facility. So a single standing facility within a park type environment, absolutely, I think is the way to go going forward. However, there are still a number of freestanding assets which aren't located in parks, which are still appealing to a number of blue chip tenants, given the position and their location.
We've got a specific question from Paulo. Are you receiving rental from Consolidated Steel Industries?
Yes, we are, absolutely. So Consolidated Steel Industries went into business rescue, and in terms of that process, they had to eventually give up some space at two of our facilities, one in the Western Cape and one here in Gauteng. But they did manage to have one of their subsidiary companies called Global Roofing Solutions continue to occupy. And yes, they do. They're not in arrears. Yeah.
And then just a question from my side. There's obviously been a lot of development activity within the industrial space over the last 7 years. How much demand is out there for net new space? Or is it now a function of consolidation and leaving space behind? I do worry about an oversupply situation, 3, 4, 5 years down the line. Are you concerned about that, or do you feel that there is significant demand to take on supply as it comes online?
So, the driving force is GDP at the end of the day. And sadly, GDP has been under massive strain since 2012, 2013. So, you know, the growth of new businesses, the growth in GDP, unfortunately, is not there. And that certainly impedes the ability for new developments as such. However, having said that, there are those businesses, you know, within the pie itself. So the pie isn't necessarily growing, but within the pie itself, there are businesses that are managing to grow. And, you know, for those businesses, there is still the opportunity for them to want to be in, what shall we call it, relevant space, modern space, which is conveniently located to their supply chain and or their customer base. So we do find that there are still some businesses wanting to take on either additional space or else relocate into more favorable sort of areas. And that does obviously, you know, spur new developments as such going forward. But without a doubt, until such time as the economy actually turns and picks up and that, you know, there is a growth in terms of new businesses coming into the economy, I think it definitely will impede the ability for new developments going forward. So it will be demand-based is what I'm saying.
A question from Jared. What are you seeing in terms of development cost trends?
So, you know, development cost trends, the construction industry has been massively impacted also. And as such, we do believe that on the main, their prices remain fairly competitive. There are certain components within the construction industry which are certainly escalating at astronomical figures, the likes of steel and possibly copper going forward. So that does impact on prices. But I think to a large extent also what is impacting on the total development cost is the land cost component. And we do find that in, you know, the areas like in KZN and in the Western Cape, land costs are exceptionally high compared to land costs, you know, in Gauteng. So these are factors which we do obviously try and work around as much as we can, but they obviously are beyond our control.
And just if you can separate land cost to top structure cost, you know, what sort of a average per square meter, or could you, you know, put up a top structure excluding land?
Yeah, so top structure all inclusive is coming in around about, call it 9,000 Rand a square meter, all in, including land. If you take the land component out, land component is normally between 20 and 25%. So you're probably talking about 7,000 Rands for top structure on its own.
Thank you. And just a question from Yusuf with regards to a follow-up on the supply. With a lot of new supply and warehousing having modern specs, can one still do well out of older industrial facilities, or is there a risk of obsolescence? What kind of property specs are regarded as being obsolete?
Yeah, so it's a very good question. And I think when you start talking about sub-segments, it becomes more relevant. So if you're talking about distribution and logistics as an example, it is more relevant. When you're talking about possibly manufacturing or just warehousing as such, it's less relevant. So from a logistics and distribution point of view, the reason it is more relevant is because their operating business world is incredibly competitive. And in order for them to be competitive in terms of the products that they deliver, they need to cut down on their costs as much as possible, of which accommodation or the space that they occupy is but one component. But the other component is the cost of transport. And so the location relative to where they receive goods and whether they're distributing those goods is also critical for them. So the less they, you know, on the roads in transporting the goods, the shorter the distance they travel, the better it is for them. Coming back to the actual product itself, it stands without reason that if they can pack and stack their goods higher, they occupy a smaller floor space, which means that they then pay a lesser rental because rental generally is still charged by area as opposed to by cubic space. There is still a market, especially now in South Africa, given the effects of COVID. There are businesses that are consolidating, and they don't necessarily need to be in the sexiest, newest space around. For them, it's a question of just functionality, you know, just being able to operate their business and it doesn't have to be the newest type facility at the most expensive premium rentals. So it's a question of getting the balance, not being overexposed to either of those two components.
Just a question on PV and solar, and please, this might be a silly one, but given the opportunity with regards to space on roofs and low energy usage by the underlying tenants, is there profit to be made in selling it to the grid, or is that not an option with regards to selling it to the grid?
We do believe that there is huge opportunity for us going forward in that field. Okay. And the start of it is the lifting of restrictions in terms of the independent power producer restrictions. So that first step has happened, and we're very pleased with that. The second component is to get the local authorities to buy into the concept of the wheeling as such, and at tariffs which make it feasible for us to do it. I do believe that, given the pressures that Eskom is encountering, that somebody will see the light going forward, excuse the pun, and that they will eventually come to the party, and that the opportunities will be there for us to then optimize the space that we've got on our industrial facilities to maximize PV output. And the reason that's so important for us is, just to give you an example, if a manufacturing facility operates 7 days a week, your PV produces power at least 7 days a week. A manufacturer only works 5 days a week. So there are 2 days in the week where effectively the PV can't be used. And that's where wheeling it back into the grid makes a lot of sense for us.
And then just something that was, I think I actually asked the question last year because it was quite topical, is that the opportunity for onshoring, maybe not manufacturing in South Africa, given there's not a stable supply of electricity, but maybe more, requirement to hold more stock. Have you seen, those trends come through that, your same clients are requiring, more space to hold stock longer than they did before?
I can't really say that we have seen that trend per se. Okay. Most of the guys who are in the logistics type industry are there because of the turnover of the goods, as opposed to the actual storage of the goods, which is typically a warehouse type component. So I can't really say that. However, I must add that I think it is critical for us to become proudly South African again, for the guys to start buying South African. Because that's the only way we're going to sort of impact on this unemployment situation that we've got, and try and boost the economy, try and create a bit of consumer confidence, and help the whole process grow. So I do hope that we will be able to improve on our onshoring going forward.
And then just one final question from me, and we haven't actually touched it in the other sections, but just administered pricing in the industrial sector, it just forms a larger component of the total cost. And it continues to drive and crowd out, base rentals. Yeah. What are the mitigating, how do you mitigate these risks going forward? What can you control?
So unfortunately, with administered costs, we can't control it. Thank goodness we do have SAPOA as a representative body who is all out supporting us and trying to take up the matter with all the necessary local authorities. And as an industry, we have to support and continue to fight the fight. It really leaves a bitter taste in one's mouth when you are paying these exorbitant sums of money in terms of assessment rates and also for electrical tariffs. And we continue to get the power outages that we are experiencing. And the fact that we know that, the infrastructure is not there, whether it be in the form of water supply, whether it be in the form of roads, the infrastructure has not been maintained in spite of the fact that we're paying these exorbitant administrative costs. So it is something that we do believe that the local authorities have not been playing fairly.
And just before I get to Paula's question as the last question, but just adding to that infrastructure, have there been nodes impacted so much that the infrastructure has been degraded that it's become almost impossible to operate?
I'm afraid there are certain areas where that has been the case. It's not just a question in terms of infrastructure per se, but also a question of crime. I think we're finding that there are a number of tenants who are saying that they want to avoid particular areas because of congestion, because of infrastructure in terms of roads, and also because of crime. Yeah, absolutely.
Just from Paulo, are there any buyers for manufacturing industrial assets besides tenants wanting to own their own building?
Good question. We have not found that, I guess from a manufacturer point of view, for any existing business which probably is taking a huge amount of strain currently, cost of occupation has to be as low as possible for them, because they're in the primary stage. Their margins on the products that they produce at producer level are far smaller than the margins that they achieved on the products at retail level. So I guess for most of these manufacturers, they'd much rather employ their capital on the manufacturing component as opposed to the space that they occupy.
And then a final question also from Paulo. Are there any opportunities to convert multi-let assets, parks into DC's big box logistics assets, or the current valuations are not feasible?
To a large extent, I would say that the current market rentals don't make it feasible to that effect, coupled with the fact that a modern DC it talks about height, it talks about super flat floors, it talks about column spacing, and these are things which are very costly to retrofit from a multi-tenant type facility, unfortunately.
Brilliant. I think that's all the questions we've got from the participants and myself. Thank you so much for your time, Errol. Maybe some concluding remarks before we close the session off.
So I'm amazed at our South African resilience. We've gone through a massive pandemic, both locally as well as internationally. But from a local point of view, the businesses were keen to get back into the business again, business frame of mind. We've had looting. The businesses again picked up and got back into the business frame of mind. So I'm just incredibly proud of the way the guys just keep on going at it, and long may it continue.
Thank you so much, and thank you to the participants. With that, I'll close the session with one more session to go. See you then.
Thank you.
All right.